Okay, so for this video, I wanted to talk about this Backdoor Roth IRA. How does it work? How is it reported? It's made headlines recently because in the Build Back Better bill, they are trying to get rid of this, let's call it a tax loophole, where wealthy individuals have otherwise been unable to contribute to Roth IRAs are using this system to get into a Roth IRA, right? So remember, Roth IRAs are generally more beneficial because when you put the money in, the growth is completely tax-free, and when you draw the money out, it's also tax-free. Versus traditional IRAs, you put money in, you get a deduction, and then when you take the money out, you have to report it as income to the extent it exceeds basis in the traditional IRA. So I've got one slide in front of us, cover some of the rules and the reporting. And then I also have a sample 8606 and tax return where we'll cover how does this mechanically actually get recorded on the return. Okay, so again, what is a backdoor IRA, right? So high income earners are not eligible to make contributions directly to a Roth IRA. So Roth IRAs, you can only make a contribution if your income is below certain thresholds on a yearly basis. So if you make a lot of money, Roth IRAs, if you make a contribution to it, that's in violation of U.S. tax law. You actually get penalized for putting money in until you take it out. So high-income taxpayers, though, although they don't have Roth IRAs, they can still make contributions to traditional IRAs, right? Now, traditional IRAs, even though they could put the money in there, they're not allowed a tax deduction for the contribution, which in their minds is okay, right? Because if you put money into a traditional IRA, you might not get a tax deduction, but the earnings grow tax deferred, right? So you can put money in, it grows tax deferred, and then it's not until you take money out of that traditional IRA are you recording it as income and paying taxes. So for high income taxpayers, there's definitely a lot of utility with traditional IRAs. I highly recommend using them. In this case, though, we're talking about the backdoor Roth conversion, so it's a little different. But what this effectively does is it allows a high-income earner to contribute funds to a traditional IRA and then roll the money into a Roth IRA, and you get around this whole direct Roth conversion or contribution issue. Okay, so let's look at a step transaction here just to see kind of how this works. So in our example here, we have John. He earns a lot of money, so he's a high income earner, so he's not eligible to contribute money directly to a Roth. However, what John can do is he can make contributions to his traditional IRA. He just doesn't receive a tax deduction for them, and that's okay. John's all right with that. So what John does is he contributes the yearly maximum to his traditional IRA. In 2021, it's $6,000, and he makes this deposit on June 1st, 2021. Then, 4 days later, on June 5th, 2021, John instructs the custodian that has his traditional IRA to make a direct rollover of the $6K into a Roth IRA held with the same custodian, right? So you can open a traditional and Roth IRA. They're separate accounts. You can have them with the same custodian. That's okay. Now, from a reporting perspective, what happens here is the custodian has to prepare a 5498, which shows that John made an original contribution of $6K into that traditional IRA. Okay, so $6,000 gets deposited into the traditional IRA. The 5498 is sent to the IRS, and John gets a copy. Then the custodian prepares the 1099-R, which shows the distribution from the traditional IRA and the direct rollover into that Roth IRA, right? So the $6,000 that comes out of that traditional IRA, it's reported on the 1099-R, but the custodian can mark it as a direct rollover to another IRA. So again, John gets a copy of this, the IRS gets a copy of it as well. And then lastly here, the custodian has to prepare another 5498 for the amount of contribution into that Roth. So the $6K that comes out of the traditional IRA into the Roth, you get another 5498 disclosure. So a lot of admin here, a lot of forms, but this is all necessary to document the steps. And then lastly here, all of this has to be appropriately recorded on John's tax return. So on his Form 1040, he needs to include the 8606 to report two pieces. The first is that non-deductible contribution to the traditional IRA, and then the second is that direct rollover from the traditional IRA into the Roth. So if we look at the 8606 here for John, so again, this is used to report non-deductible contributions into a traditional IRA, and then also distributions from traditional IRAs, and then as well as the rollover component. So for John, this is, again, he's not filing this separately. This goes along with his Form 1040. So in part one here, what he's starting with is how much did I put into that traditional IRA during the year? $6K, right? So $6,000 on line one went in. Now line two, your basis in your traditional IRA is what's rolled forward from prior year 8606s. In John's case, he doesn't have any basis in the traditional IRAs because all he's doing is putting money in and constantly moving it out. So his basis is just going to be zero, right? He has no basis in his traditional IRAs. Okay, so then as he moves on down the form here, the next relevant section is line 8, right? So enter the amount from your traditional IRA that you converted to Roth, right? So in John's case, 6K went in, 6K went out into the Roth, so he's reporting $6,000 on line 8. And then we do some simple math here. It asks us to divide line 5 by line 9, right? So what we're doing here is we're dividing the total amount here reported on line 5 divided by the contribution or the conversion rather from traditional to Roth, and it's just a 1-for-1, right? Again, we're just having money in, money out. What they're doing here is they're trying to calculate if there's going to be any taxable inclusion for the current year. As long as John puts in 6K, doesn't invest it in anything, and then moves out the same 6,000, this is what the format's going to look like. It's going to be a 1-for-1. If, for example, John put in 6,000 and then invested it and earned some investment income and then tried to move the money out, you might have an income inclusion here, right? So there's going to be a non-taxable portion that was not perhaps converted to a Roth. So as it instructs us here, right, you also enter this line item on line 16. So if we scroll down to part 2 here, this is where we have the conversion section. So 2021 conversions from traditional to traditional SEP, simple IRAs to Roths, right? So it's any one of these classes into a Roth. So part 1, this is our $6,000 number. And then also we're pulling the $6,000 number from part 1, line 11. Now the taxable amount here, again, the issue is if you're moving money in and out that is not of equal value. So if there's some appreciation in the assets or you have some basis in the traditional IRA, you might have a taxable amount that's included here that needs to be reported on your Form 1040. But in most cases, this does not happen because of the mechanics of the contribution. So most individuals, what they'll do is they'll keep very tight windows on these contributions, right? Put the money in on June 1st, and then within even a day or two, right? I mean, I recommend my clients have just contributed it almost immediately to make sure there's no income inclusion whatsoever. So money in, money out, and then there shouldn't be any taxable amount that's recorded for the current period. Now, if you have a traditional IRA that's been open for a number of years, this is a completely different system, right? I mean, you could absolutely have some kind of taxable inclusion if you had a traditional IRA that was building up value for many years and then you converted it. But this step transaction is what's being done on a yearly basis, right? Taxpayers are doing this every single year. Money into the traditional, move it to the Roth, report it like this on the 8606, and then there's no taxable inclusion. And you've got money into your Roth IRA so it can grow tax-free, and when you take the money out, it's completely free of taxes. So now once the 8606 is completed, what we'll see is if we look at John's page 1 of his 1040, here we have line 4A, we do have the distribution amount reported, right? Because remember, the money went into the traditional and then it came right out. So it technically is a distribution, but the taxable component here is 0 because this was a direct rollover into a Roth IRA and there was no basis differences, so there's no taxable inclusion for the period from the traditional to the Roth conversion. Okay, so that covers it for this tutorial. I hope that was helpful. Again, the Backdoor Roth has been around for a while, still in existence now. Whether they do away with it, who knows? We'll see what passes. But that covers it. I hope you found that was helpful. If you have any questions, please leave me a comment below. And I look forward to seeing you again on the next video. Thank you.